Have you ever been pitched an insurance product thinking, do I really need life insurance? Well, today what we're going to do is we're going to unpack three specific examples to when we should look at executing on life insurance and what types of life insurance we should look at for that specific problem. My name is Luke Turner, co-founder of Bowman Private Wealth, where we help athletes and entrepreneurs get smarter with their money. Whenever we're working with a client and we're in a situation where we think that we need life insurance for one reason or another, we always roll back to the need that we are actually trying to solve for. The way that we approach life insurance planning is life insurance is there to solve for a need. It's not an investment. We don't intertwine those two things together, but rather what we say is, okay, what is the need that we need to solve for this situation? And then what is the best option from a cost perspective and a value perspective that a life insurance solution may be able to solve for us? So typically what we're looking at in these situations are three things. One, what is the situation that the client is facing? Two, what is the need that the client has? And then three, what is the solution that best fits that need in that situation? So for us, what we're going to do in this video is we're going to break down three specific examples of when we actually do need life insurance. So the three examples that we're going to look at today are: one, we are going to look at what is a good solution for a client that is trying to solve for supplementing their income if they can no longer provide income for their family anymore. That's the first. The second is what happens in a situation that you need to buy out your partner's shares, but you do not have the liquidity to buy them out. It's called buy-sell insurance. That's the second. And then the third is going to be estate taxes. So if you have over $13.6 million in net worth, there are certain insurance policies that can protect your family from potential estate taxes into the future. So those are the three components we're going to look at today. Let's go ahead and dive in. Okay, so the first situation that we're going to dive into is supplementing your income if you can no longer provide for your family. So let's just draw out a little scenario here. We have John. John runs a small business. He has built a great life for his family. Over the course of the last decade, he's put his family in a situation that now his wife's able to work from home. They've upgraded their house. They've been able to go on some nice vacations. Their kids are in the schools that they want to go in. And one thing that John has become more and more fearful of is he realizes that if he is not here to run the business income is going to go away. His business isn't to the point where he can really be an absentee owner where, those shares could pass along to his family and that income would still coming in. So for him, he wants to make sure that he solves for this situation that if I'm no longer here to provide for my family, what is my family going to live off of? So in this conversation, he then has a conversation with his advisor, and his advisor is going to break down a couple of different things that we need to look at. So first we need to determine what is the need before we even consider any solutions. So the need is going to be replacing his income. So we're going to look at different components that go into play when we're trying to solve for this. So what is his current mortgage? What does it cost to be John? What does his current income actually look like today? What are potential capital expenditures that are known? Things like potentially paying for college, continue paying for the school that they're in today. Taking into account all of the known factors, and then we're going to reverse engineer it and we're going to back into what is the amount of money that John's family could potentially need in a lump sum in order to sustain that lifestyle for a certain number of years or in a perpetuity, depending on what we actually want to solve for. So that's the process that we're going to go through. And once we go through that process, then we're going to now look at, okay, what is the solution? And when we look at replacing income, 99% of the time, we're going to look at term insurance policy. Term insurance is probably something that you've heard of in the past, but I think it'd be helpful in this video to even just break down what are the different components of a term policy and just really simplify it for you. So typically there are only three components to a term policy. There's the premium that you pay to the insurance company. So the cost that you pay in order to get the benefit. Okay, so that's the annual premium. That's the first component. The second component is going to be the death benefit. Okay, so the death benefit is going to be the amount of money that your beneficiary is going to receive if you were to pass away. In this situation, let's say that John buys a $3 million term policy. All this means is that if something were to happen to him, he's going to collect $3 million in insurance benefit his family is going to. And then the third component is going to be the term itself over the course of the policy. So the term is going to be the amount of years that you're eligible to pay the annual premium in order to receive that death benefit. One thing to note on term policies is that typically term policies have a set premium over the course of that term. So say it's a 20-year term policy for $3 million and you're going to pay $1,000 a year. This would mean that over the course of the next 20 years, if you pay that $1,000 a year, you are going to have the right to a $3 million death benefit if something were to happen to you. So those are the three basic components to a term policy, and that is typically what we would recommend in these types of situations. One other component to a term policy that I believe is something very important that every term policy should look into is making sure that it is convertible to permanent insurance. All this means is that there are term policies that are convertible and not convertible. A convertible policy means that after the term is up, so in our example, 20 years, on the 21st year, you couldn't pay that $1,000 to keep $3 million in insurance, but you could convert it to a permanent policy, which are much more expensive, but it would allow you to continue keeping that insurance. And the reason why we want to have that in place is there are situations that maybe your health condition has changed, maybe you've gotten sick in year 20 of your policy. Having that flexibility is often something that we want to have when we look at term policies. So again, that kind of wraps up our first section, which is supplementing your income if something were to happen to you. Our second situation is buy-sell insurance for our partner in the business. So this is a common thing that comes up as it relates to business owners and entrepreneurs. So let's draw out a situation here. We have Joe and Sam. Joe and Sam have started a business out of their garage. They started it when they were in college, and now they're to the point that it's a thriving multi-million-dollar a year business. And every couple of months, they get one of those unsolicited LOIs from a national private equity company that's trying to roll up their business into a portfolio company that they own. And one thing that occurs to them in the most recent LOI that they received from their private equity company is that they could not buy out the other individual shares. So let's just draw out the scenario that the unsolicited LOI, the offer from the private equity company was $20 million. They each own 50% of the business. And they look at each other and they say, well, do you have $10 million? And the other one says, I don't have $10 million. And so Joe and Sam now have this predicament that if Joe or Sam were to die, neither of them have the flexibility from a financial perspective to actually write a check to the beneficiary of that business and buy out those shares. So this is where buy-sell insurance comes into play. So that's typically the scenario or the case study that we're looking at when we're starting to go down the path of buy-sell insurance. So again, the need for this situation is how do we put a life insurance policy in place to ensure that no matter what happens in the business really continues on after one of the partners were to pass away. So this is something we want to make sure we have in place to make sure that there is longevity in the business. Now, this is good for your employees. This is good for your families. This is good for the customers of your business, making sure that things don't change if something happens to one or both of the partners. Typically, from a solution perspective, when we look at buy-sell insurance, this is not a one-size-fits-all. This is not a 99% of the time, but rather this is a case-by-case basis. One thing that we're always looking at when we're trying to solve for this solution is there a cash value need for the owner themselves? Is there the beneficiary, is this somebody that's going to want a lump sum of money for the shares? For example, is this a spouse? Or potentially, is this other family members, and maybe this individual who's running the business is single, but the other partner has a wife and kids. So depending on the dynamics, it's going to depend on what the solution is going to be. But there is a good probability that you can solve for this need in the short term with a term insurance policy, which is what we've already talked about, where we say, okay, what is the value of the business? How much are those shares worth? Let's go ahead and have a policy in place that can buy out those shares. Now, buy-sell agreements are typically much more detail oriented. There's much more there's more legal implications than the way I'm drawing it out in this scenario. But it's still better than nothing to say that, okay, maybe business is worth $20 million. We each get a $10 million insurance policy, and now we can pay out to each one of those owners if something were to happen. That's often a solution we can have. Another solution is more of a permanent solution where maybe we buy a permanent policy where the premiums may be a little bit higher, but that insurance is going to be in place potentially forever. And there are many different benefits to putting a permanent policy in place in this situation. But again, this is going to be very dependent on what are the needs of the actual owners of the business and what does that buy-sell agreement actually say. So that's the second scenario. You each own a company and we need to buy out those shares if something were to happen to one or two of the business owners. All right, the third situation we're going to look at is estate taxes. So first, before we dive into this, let's again break down the three things that we're going to look at. One, we're going to look at a little case study. We're going to look at what is the need that we're trying to solve for, and then what is the typical solution that we need to implement. So let's look at a case study. Let's assume that we have Roger, and Roger has a $30 million net worth. He is not married, does not have kids, but he still very much wants to make sure that he's optimizing the money that he has. He's optimizing the decades of work that he's put in to get to this point in his life from a financial perspective. And one thing that has been brought up to him from his advisor is that when you have over a $13.6 million net worth, and again, net worth is if you add together all of your assets, subtract out any liabilities, whatever that number is, that is going to be your net worth. And what they've determined is that 30 million is a much larger number than 13.6. So we're now in a situation where he is going to be subject to estate taxes. So what are estate taxes? What do they actually look like long term? We're not going to dive into that deeper into this video, but if you do want to check out the comments below, in the notes, we're actually going to have one of the blogs that we recently wrote on estate taxes and estate planning. So check out that blog if you want to learn a deeper understanding of estate taxes. But back to our scenario. So he realizes he has this problem. So let's look specifically at what that need is. So in the estate tax situation, he would owe about, we'll call it just an approximate number of $6.5 million in estate taxes if he were to pass away today. So the biggest thing that we were trying to solve for here is either one, the client simply does not want to pay these federal taxes to the government, or two, he is owning and operating a business and does not have the financial flexibility to pay those taxes if something were to happen to him. So I think one is a little bit more straightforward. Two, let's just look a little bit deeper at this. So one situation that we need to be very cautious of with estate taxes is we don't run into this single owner business that is operating and that owner passes away. If they owe estate taxes, typically those are owed in 90 days. And now we're in a situation where if you don't have, in this situation for Roger, $6.5 million, oftentimes this can cause you to have to sell your business. And for the clients that we're working with, oftentimes that is not a good solution. We don't want to have to sell our business to pay estate taxes. So what do we do in this situation? Well, we buy life insurance. So let's look at the solution that we can come up with to solve for this. Typically for estate taxes, these are almost always permanent insurance policies. So in this video, we've talked a lot about term life insurance, term policies, but let's do a little bit deeper dive into permanent and when we would use those. So in estate taxes, typically we're buying permanent insurance policy. And when we think about permanent insurance policies, there are a number of different solutions that are underneath the permanent umbrella. But in this situation, let's go ahead and just look at what we would call a whole life policy and look at what this could potentially look like for somebody like Roger who has a $30 million net worth and is over that $13.6 million estate tax limit. So on the permanent insurance policy, there's going to be a couple of different components. Again, there's going to be the annual premium. What do we actually pay to get this insurance policy? There's going to be the death benefit, which is going to be the amount of money you're going to get if you pass away. And then there's also going to be a term, but the term is the entire lifespan. As long as you pay that premium, you are going to get that death benefit. The other features to a permanent insurance policy, other than the main one, which is that you can pay the premium forever and you can ensure that life insurance is going to be there forever, is that it accumulates cash value. So cash value just means that as you put money into the policy, all of those funds do not just go to the cost of insurance. A portion of those actually stay in a bucket of money that's invested by the insurance company, and then the insurance company will pay you a portion of what they make, and they call it a dividend. So from a cash value perspective, there is a benefit there that all the premium that you put in does not necessarily only go to insurance costs, whereas in a term policy, if you pay them $1,000 and you don't pass away over the course of the next 20 years in your 20-year term policy, you're not going to get any money back. Whereas in a whole life policy, there is going to be a cash value component where there is something that you actually can invest and you own inside of that policy. So when we look at these types of situations from an estate tax perspective, we are very cautious of saying, although permanent policies typically cost a little bit more, they're almost always the best solution when we're trying to solve for estate taxes. Because again, our need is a permanent need. This is a need that we are going to have if you were to die. So we need to make sure that we put ourselves in a situation of, if you were to die, what is the amount of life insurance you're actually going to receive? So that wraps up the three components or the three different situations where we would typically utilize life insurance. And let's just do a little bit of recap. One is going to be where you're supplementing income for your family if you can no longer provide for them. Two is going to be a buy-sell situation where you need to buy out your partner's shares in a business. And then three is going to be estate taxes. So when you have an estate tax liability and we actually need to pay out those estate taxes. If you are at all confused about either life insurance policies that you have or why you have the life insurance policies, one thing that we are always happy to do is just review those policies, give you a second opinion, second set of eyes on what is the solution, what is the need we're solving for, and just make sure that you have the right policies in place. If you have any questions around that, feel free to check out the link below where you can schedule a call with our team. Hope you have a great day.